Hey folks, welcome to a product review at Finominal. Today we're going to look at GARP funds. Now, GARP stands for Growth at Reasonable Price. And the idea here is simply to invest into growth companies, but not overpay, and well, try to get them at a reasonable price. We selected 4 products. 3 are ETFs from Invesco, SRH, and iShares, and 1 is a fund from JP Morgan. So let's see in terms of if these funds are achieving what their name implies, in a sense of providing exposure to growth stocks while not overpaying. Now, the first thing we're going to do is look at the portfolios, right? If they are comparable from a whole, like number of holdings perspective. And we can see approximately, yes, you can see the product from iShares with the ticker GARP. It has 150 stocks versus most concentrated is the product from SRH with the ticker SRHQ, 64, but kind of moderately concentrated portfolios. And less diversified than the S&P 500. We can also look at the overlap to the S&P 500. And here we do see that in general, the overlap is fairly small, except for the product from JP Morgan with 52% overlap and the product from iShares with a 43% overlap. Now, let's move on to holdings-based factor exposure analysis. So here we see the portfolios on a number of technical and fundamental metrics. And the ones that we're going to focus on is valuation and growth. So from a valuation perspective, we do see surprisingly that there's only 2 products, which is the one from Invesco and the one from SRH, where the underlying stocks are trading at lower multiples than the S&P 500. So the product from JP Morgan and the product from iShares, the valuations are cheaper than the ones from S&P 500. Now, so that's kind of like a little bit concerning. From a growth perspective, how would you see that all rank highly, well, more or less, except actually the product from SRH, on EPS and sales per share growth? So you are getting at least the 3 products portfolios with growth stocks, right? But as mentioned, not all at reasonable prices. What's also interesting is that they tend to be more volatile than the stocks in the S&P 500, and the momentum tends to be on the kind of lower negative side. So most recently, these stocks have underperformed compared to the S&P 500. From a profitability perspective, there's a lot of dispersion here, right? So some funds seem to be a little bit more favorable, right? Where other ones are less favorable. So overall, these portfolios seem to be quite different. Let's complement this kind of like holdings-based factor exposure analysis with a returns-based factor exposure analysis. And it's worth mentioning that we only have, I think, 2.5 years of history. That's simply because I think one of the products from iShares and from SRH, they were only launched recently. So what's kind of interesting is to see the betas to like equity factors like value, momentum, low volatility, quality, or even like the size factor, that they are all over the place. So that effectively confirms what we've seen on the holdings-based factor exposure analysis, that the underlying portfolios are quite different. What is also worth highlighting that 2 of the products, the one from JP Morgan and the one from iShares, that these feature higher betas to the S&P 500. So to a degree, they are almost like leveraged products. Now, we can move from factors to sectors and see what we observe over here. So here there's only actually 2 funds worth mentioning. We do see the product from Invesco that has a large bias towards energy stocks and financials, while it has an underweight to tech stocks. In contrast, we see the product from JP Morgan and the product from iShares that they have an overweight compared to the S&P 500 to tech stocks. And that's kind of expected, right? If you recall, the beta to the stock market of JP Morgan's product and the iShares product, right, was above 1. And they also had a highly volatile stocks, right? And that's just the mirror image of having a like a bias towards tech stocks. which have outperformed, right, and tend to be more volatile. Now, we can actually look at the performance of these 4 products. And as mentioned, we only have a short time period here since 2022. We do see that actually the product from iShares and the product from JP Morgan have outperformed the S&P 500 as well as the products from Invesco and SRH. As mentioned, we can simply explain that by having a higher beta to the stock market, 1.1 and 1.3. Or you can also explain it via the sector exposure, the bias towards tech stocks. And of course, they have performed quite decent over the time period, right? And then we can look at that from a risk-adjusted perspective. And indeed, we do see that those 2 products that outperformed also have the highest volatility, right? So it's all consistent. From a Sharpe perspective, right, it is worth mentioning that actually the product from, I think, iShares actually has performed best despite the highest volatility. But I think we should kind of disregard that because 2.5 years is not that meaningful from looking at funds in terms of risk-adjusted returns. That's just not meaningful. So what have we learned so far in terms of looking at those 4 products, right? We have seen that performance has been different simply because the underlying portfolios have been quite divergent. We can also see that from a name perspective, right? Actually, 2 of those products feature quality in the name, right? So it's not only that these are supposed to be growth stocks at reasonable valuations, but they also have a tilt towards quality. Now, 2 of these products, namely the one from Invesco and the one from JP Morgan, do actually have a track record that goes back further. So I think more than 10 years. So let's exclude those 2 other products, the one from SRH and the one from iShares, right? And so here we can see a track record going back to 2011, right? So we have, well, 14 years, right? And we do see that the product from Invesco has outperformed the S&P 500, right, for most of its period, except most recently, while the product from JP Morgan has, outperformed the S&P 500, for the last 10 years. Having said that, there is nothing magical here, right? We do like outperformance, but only if we cannot explain it. In this case, we can explain it, right? Simply because those products have these bias towards, at least the one from JP Morgan, right? Has a higher beta to the market, right? That is explained via that large bias towards technology stocks. So you could also compare it to the Nasdaq, and both of those products would have significantly underperformed the Nasdaq. What's more interesting, if we do look at these products from a Sharpe perspective, because you could argue, hey, growth at reasonable price, that this should be a kind of like a nice way of getting exposure to expensive growth stocks and should lead to higher risk-adjusted returns, a higher Sharpe ratio. But actually that has not been the case. So over the last 14 years, the product from Invesco has generated a Sharpe ratio of 0.72. The product from JP Morgan 0.79, but that's pretty much the same thing as the one from the S&P 500. So that concludes our review of GARP funds. As mentioned, growth at reasonable valuations or price, to be precise, is a kind of intuitive concept, right? Having said that, if we do look at the performance, right, from an absolute perspective, also risk-adjusted perspective, there's not a lot of magic here. We do see outperformance, yes, but we can explain it with a higher beta, and you can get that via a leveraged S&P 500 ETF, right? So it seems to be that this is, well, it's a nice story, right? But that's effectively it, right? It doesn't lead to outperformance or high Sharpe ratios. Hope that helps. Have a nice day.